Okay, so to kick off, a big thank you to Shares and for hosting us tonight, and also AJ Bell. The disclaimer, which I'll take as read. So what is Ecora? Simplistically and in a nutshell, Ecora is a business, it's a royalty company financing the natural resource sector, and our strategy is to build a portfolio of commodity exposure diversified in tier one mining jurisdictions, such that by investing in Ecora, an investor has relatively de-risked exposure to the energy transition thematic. So your first question may be, well, what is royalty? And that's one that we get often. So we put this slide here. And a royalty is very simple. Effectively, we provide mining companies or developers with capital. And in exchange for that, when resources are extracted from an area where we have our royalty, we receive a percentage of the sales price. So not too dissimilar to a music royalty, where every time a song is played, an artist may receive a fee or a royalty fee for that. In this instance, it's for the extraction and then the sale of resources. And that's very different to being a mining company. I mean, first of all, we have a footprint of 13 people. We don't operate mines, we don't own mines, we don't have many of the risks that mining companies do by virtue of the fact that a mining company has huge operations, right? A huge staff. The mining company is responsible for the capital costs of building a mine. And if those costs are higher than expected, that generally is borne by the mining company. So our cash flows, therefore, are very much a function of what is the production, and number two, what are the prices of these underlying commodities? And that really matters in a world where you see inflation. The point I always make, 20 years ago, copper cost $1 per pound. Copper today is $4 per pound. And we don't know in 20 years if copper will be 16, so 4 times higher. But what we do know is through the royalty model, you're able to get that exposure with the inflationary trend. Whereas if one invests in a mining company, very few mining companies have seen 4x margin expansion. So to explain that, what I mean by that is if you had a 1% royalty, $1 per pound, that would give you 1 cent. Fast forward 20 years, that would be 4 cents per pound. So it's a great way to get the exposure in a relatively de-risked way compared to going directly into a mining equity. So our commodity selection, to understand Ecora, you have to understand that around 10 years ago, this business had one asset, really, of substance, and that was a steel-making coal royalty. And it has been a fantastic royalty that's generated fantastic cash flows for this business. But like all good things, it was coming to an end in 2026. And so at the time, we thought to ourselves, well, what are the mega structural trends that we anticipate happening as we think upstream in terms of natural resource demand? And the one thing that consistently sort of stood out was the fact that, over this century, or hopefully the first half of the century, but over this century, as a society, a global society, what we're hoping to achieve is a complete replacement of our stock of energy producing and consuming assets. So if you think about that, the human evolution has been, in some ways, parallel to how we capture and harness energy, starting with the horse, the steam engine, petrol, and nuclear age, and so forth. And as we unwind a lot of the hydrocarbon-based energy sources, we're effectively replacing a huge stock of capital that therefore requires an enormous amount of materials to achieve. And not only that, not only are we talking about meeting growing energy demand globally, we're talking about replacing all of that stock of energy materials. And so in that thematic, therefore, we said to ourselves, okay, we will target, number one, renewable energy production or low carbon energy. We will target the transmission of that power, and we will target commodities that are essential to consuming electric energy or storing it. You can see on the left half of the page those commodities we have already in our portfolio, and others that we loosely look to target as part of our optimal portfolio construction, such that with Ecora, an investor could, as we continue to grow and diversify, get that relatively de-risked exposure to the energy transition thematic, which should hopefully appeal to those who are long-term investors and who believe in this structural underlying trend for commodity demand. When we started 10 years ago, as I said, we had a problem. And that problem was we had one key asset that was going to run to the end of its life in 2026. So our challenge as a team has been to replace those assets. And we feel that we've done that. And not only have we done it, but we've done it with mining companies who I think most of you will know. The market value of those folks operating or producing mines is approximately $200 billion. So while Ecora is a small cap business, we are not small cap mining risk, right? It's a nuanced distinction, but it's an important one to keep in mind when one evaluates the risk reward potential of the equity. And our growth pipeline, again, is with really well-known folks in the mining sector. One of our core development royalties, nickel copper asset in Australia, is in the process of being built by BHP. Capstone Copper, Santo Domingo in Chile, amongst others. These are the core of the portfolio are really high-quality assets, and that's certainly not an accident. We've been very methodical and deliberate in targeting high-quality mines in good-quality jurisdictions. And actually, I should make that point. Our portfolio is almost 90% plus OECD. And if you include Brazil, very quickly you get to 100%. So we've been able to build a portfolio with good-quality operators in what we perceive to be the right commodities, all while maintaining what started as a jurisdiction footprint that was close to 100% OECD. So this is the opportunity, I suppose, for the investors today. The business today, in terms of what's priced in, is pricing it at a level where the value of the producing portfolio is less than the current share price. So we think that's possibly a function of the fact that, number one, there's a lot of macro uncertainty, right? A lot of folks perceive mining to be a risky sector. And therefore, in the context of some of the news with London-listed mining companies, it may be that there's been risk-off sentiment to development royalties. I guess the way we see it is that there's a lot of sort of asymmetric price risk, right? And that the entry point is for producing assets. The upside, of course, is the near-term development portfolio, which, again, in my opinion, certainly has value, and certainly if you look at precedent transactions in the sector, would suggest that these assets also have value. That's not factored in at the moment. This gives you a feel for where we are and where we're going. So as I mentioned, if you looked at this chart in 2014, it would be basically one met coal asset, and that would be this light blue line. So the darker blue next to it is the portfolio that we've built. And our goal here was to build a portfolio that, if you had $1 from this cornerstone royalty, we'd have a portfolio that would replace it. And we feel like we've done that. And on top of that, we've added a lot of growth. So that's the Ecora revenue profile with met coal running off and then being replaced by a basket of commodities, which includes copper, nickel, uranium, vanadium, amongst others. And many people, when they look at Ecora, they look at our revenue contribution, which today continues to be very heavily weighed towards met coal, steel-making coal. In time, and in the not-too-distant future, our revenue mix is expected to catch up to our asset mix. So our asset mix is 90% future-facing metals, and the met coal royalty is, on research analysts' estimates, around 10%. But that's not yet reflected in our revenue contribution. Those assets are ramping up or have not yet come online. And this is really the core of our growth story, copper. And copper is at the center of the entire energy transition thematic. Any way you cut it, regardless of what battery chemistry you believe in, regardless of whether or not you believe that it'll be nuclear versus wind versus solar, for all those things to work, copper is the key conductive material. And furthermore, copper is one element that's most difficult to substitute from any sort of end market application. The last reason we really like copper is that it's a very big market with a very diversified end source demand. And to give you an example here, the lithium market has grown from, a couple 100,000 tons to now being around 1 million tons, which is still very small. The copper is 26 million tons, of very well-established demand drivers. So what that means, we think, is that we're likely to see just less volatility in copper relative to other commodities which are very much in their infancy, that have a very positive long-term structural demand trend, but will likely oscillate in price as and when new supply is added in a very chunky way. The mining sector and mining operations are very long lead time, large capital intensive investments that are very difficult to match, unit by unit with incremental demand. So in the near term, over the course of this year, there's a whole lot to watch out for with Ecora. The first is the ramp up of the Voisey's Bay mine. This is a tier 1 nickel operation in Canada. That ramp up was expected to really take pace over the course of 24, 25, and therefore see some earnings growth or drive some earnings growth. West Musgrave's project, copper nickel project in Australia, 21% complete. The target initially was 25, 26. That may be slowed, but in any event, that one is in the process of being built. Santo Domingo is one that we're really excited about. This is an asset that we've always liked by virtue of operating synergies that existed with the mining company that owns that project. And they're publishing an updated feasibility study detailing those specific synergies in the next few months. We're really optimistic as to how that feasibility study will look, but also how that could de-risk the implied perception of our development stage royalty. Mantos Blancos is a producing mine already in operation 30 years. One of these great examples of when you invest into good quality ore bodies, usually mines get longer. And if you have a royalty that covers that area, you can end up with paying for 15 years of mine life, then having 30 years of production as upside. So this is an asset that's already seen its life of mine extended by 5, 6, 7 years and has further life of mine extension potential, but also could deliver volume growth in the short term. And this is sort of the relative rating opportunity. I won't spend too much time belaboring the point, but for the royalty sector, particularly on royalty companies focused on non-precious metals, the Ecora valuation is certainly the most compelling and attractive. So to summarize, we have built what we believe to be a world-class royalty portfolio. We think it can be improved, and we would look to improve it by, number one, diversifying the counterparty exposure, i.e. have more royalties and thus drive less revenue volatility as individual commodities move up and down. But number two, infill the commodity mix. So folks can look at Ecora like this one-stop shop where it's all things future-facing commodities. People can build their portfolios with an allocation to the thematic through Ecora, and if they're generalists, not lose sleep at night as to whether or not company X will or will not get a permit, or all the other things that can go wrong in mining. We've taken the company from a sort of declining revenue profile to one that's now amongst the highest growth on a CAGR basis in the sector. Long established track record of capital returns. We say we have a proven track record, although that's really for investors to decide for themselves, and to that end we're very transparent around what we paid for assets, how much money they've generated for us, and what brokers estimate the value is today, and such that investors can form their own view. The sustainability profile of the business, of course, has changed pretty dramatically, but less so, particularly in terms of the operations, but also the commodities. So there's a moral argument to be made that as an investor, we should be investing into cleaner and greener mining projects, but there's also a very strong economic one. Because what we've seen, and it's likely to accelerate into the future, is that cleaner and greener commodities can often attract better pricing. In some markets, it's more apparent than others. The nickel market currently is its own case study, but we've seen it for the past 5 years already in iron ore, for example. So there's a very strong economic, but also moral argument suggesting that when we position our portfolio, we should take sustainability into consideration. And then, of course, the last point, and certainly not least, is the very attractive valuation. With natural resources, even more so than most sectors, entry points are really important. And in our opinion, when markets are worried about long-term commodity demand, is really the time to get that exposure. Because there's a bad habit, I think personally, of extrapolating current pricing into the future forever, whether that be pricing that's too optimistic and too high, or pricing that's too low. And therefore, the one thing we can be certain of in commodities is that if it's low, it'll be high again, and if it's high, it'll be low again. I'd encourage everyone to have a close look at the resource sector, given what could be a very attractive entry point. So I'll stop here for Q&A.
Thank you very much, Marc.
Really interesting presentation. Okay, all there we are. I think you were just first there, so let's have your question, please.
Yeah, a couple of questions. One's probably quite an obvious short answer. The other one you partly covered. But you've had a very good record, sales level, operating profit, operating margin over the last 7 or 8 years, the figures I've seen. And the dividend covered. But 2020, what happened then? Was that COVID related? Or?
Yeah, there's a few things happening in 2020, but I think the biggest is COVID. Yeah, I mean, our operating cost base is very stable. And I wasn't joking when I said our staff footprint is 13 people. Royalty and streaming companies have very light operating footprints. And therefore, it's a very scalable model, whether we're managing one royalty or we're managing 100. It's a very scalable business model such that as the revenue profile grows, OPEX stays pretty flat. They haven't materially moved, even despite the very high inflationary pressures we've seen in the past 2 years.
Okay, and the other question was, you were talking about the metal mix going forward, and I think we'd all agree that the renewable mix is probably the area to be in the long term, and copper you're focusing on. But how much do you look at shorter term trends, supply and demand? And I'm thinking as an example at the moment, for instance, uranium, where there's a very high demand picture and a limited supply, particularly in the more stable areas, whereas lithium, cobalt may be having other issues, both on the demand side for EVs and the supply side, particularly in the example of cobalt, which comes out as a byproduct of copper. So do you say, right, we want to put more in uranium, or just look at all the opportunities as they come to you and see how the asset mix works out in 5 years' time?
So in terms of commodity selection, and this is really the core of what we do, right? By virtue of having a broader commodity set, that has historically allowed us to get attractive entry points in commodities. If you're a royalty investor, you don't really have the luxury of exiting like you can at an equity. And I'll give you an example. In the recent lithium run-up, lithium prices went from, let's take hydroxide, 15,000 to 20 to 30 to 40 to 50 to over $80,000 per ton. Now, if you're an equity investor and you invest at 50, you can still sell at 80. If you're a royalty investor, whatever price you use to underwrite your royalty will apply for the life of that royalty. And if one underwrites a royalty at $80,000 per ton hydroxide, and today lithium is around 15,000, so you'll be reminded of that for 20 years. So we seek commodities that are somewhat out of favor, right? We seek commodities that have sort of lost their sparkle, that are not the darling of the equity markets. And in part, it's because if a mining company can get really cheap capital from equity markets, they will, and they should. We don't try to compete with that. We're generally looking to pay a fair price for good quality operations, but at an entry point that is somewhere near the mid or lower than slightly the midpoint of prices through cycles.
And the royalty life comparing the royalties you take comparing the length of the royalty, 5 years, 10 years, 15 years?
Well, mining operations are highly capital intensive. So the average base metals royalty or mining project can run from 20 to 30 years, right? So the life of our investments are very, very long. And in part, over that horizon, one has to consider sustainability issues, right? One has to consider what happens if there's a carbon tax and that increases the cost of production for a mining company. So we take a very, very, very long-term view when we think about our potential investments.
Okay, I've got another question at the back next. Yep.
Thank you very much.
Trying to come to you guys next.
I've got 3 questions, if I may. 1 geographic one and 2 macroeconomic ones over here.
Okay. Thank
Hi.
you.
Interesting proposition, by the way. So the first question is with regard to battery materials.
Yeah.
A lot of the sourcing and the supply chain is in China, which obviously didn't figure on your map. Question number one.
Sorry, what was?
The battery materials,
Yeah.
the sourcing, as well as the supply chain, the entire production chain is significantly in China, which is not represented in your map. So what does that mean for your royalty allocations? I presume you can't invest in the Chinese market or fund those types of mining operations?
Yeah, your question fundamentally is, at what point and what geographies is the value chain concentrated?
Mm-hmm.
Now, the extraction of certain minerals can be heavily concentrated in China, rare earths being a very good example, graphite. But in other commodities, almost no production within domestic territory. Our portfolio has been built by deploying into non-Chinese jurisdictions, and we don't foresee any issues deploying capital into non-Chinese jurisdictions in the future, simply by virtue of the commodity baskets themselves, but also the size of the markets. So I'll give you, in the scheme of the investable universe for Ecora, graphite, for example, and rare earths are kind of a drop in the bucket in terms of the capital required. But it does present another opportunity more generally, where by investing into commodities outside of that supply chain, we can position the business to benefit from sort of macro trends or mega trends. One of them being the potential for the bifurcation of commodity supply chains, east and west. At Voisey's Bay, we have physical cobalt units delivered to us, produced in Canada, one of the best, lowest carbon footprints of any cobalt produced in the world. And you can imagine that those units are incredibly strategic to auto manufacturers in the United States and in Europe.
Okay, and two macroeconomic questions.
Do you mind just having one?
One, okay, fine, please. Sure. A lot of the pricing for miners is determined by exchanges, not by the miners themselves. So that usually represents some upside pressure on the pricing. And given how natural resources have been performing over the current year, how optimistic are you for the sector? And what are your predictions?
Well, in what horizon?
Next 5 years.
Yeah. I mean, the way to think about commodity demand and pricing is that the price today reflects supply demand today, this second, right? It's by definition. I mean, when we talk about commoditized products, here we're talking about commodities. And so when you think about something like copper, right, which has seen substantial underinvestment, which is expected to be in supply deficits starting as soon as late this year or next year and beyond, the outlook for many of these commodities is really positive. On a 5-year view, most commodities are expected to be in deficit. Not all, but the most. So then the question is, the world can't operate the world will operate in an equilibrium, and therefore if supply is in deficit, therefore there's substitution, there's thrift, there's demand destruction. But all these things point to much higher incentive pricing, because bringing a mining project in the world today is very hard, and it takes a very long time. The average project is 20 to 30 years from someone putting a hole in the ground to getting a unit out of that operation. And these are the mines that actually make it into production. Other assets have been around for 50 years. So if we're expecting short-term supply shortages, ramping up supply in response to that very long-dated activity, you would think that the dynamics, and when you look at the demand outlook, it's we're very positive and very constructive. Now, as you move shorter, though, as I said, the shorter-term picture is just a snapshot of supply-demand pressures today, right? And even forward curves don't always represent what supply-demand forecasts can be 3, 6, 9 months out. So our strategy here is not to sort of pick winners or losers on a month-to-month basis or a year-to-year basis. What we're looking for is commodities that have really strong underlying demand drivers for multi-decade trends.
Super. Next question here, please. And we'll try and come to you, thanks.
Two questions which are related. You mentioned one of the points for investing in Ecora is attractive valuation, and indeed your share price has dropped quite significantly in the last year.
Yeah.
And a lot of commodities have gone through a corrective phase, but for some reason your share price dropped quite a bit more than many of the commodities you invested in. And I'm particularly perplexed because you mentioned a lot of your revenue right now was in met coal, and met coal has been the opposite. It's done quite well. So if you could explain why that is the case, that your share price, or why you think it's dropped so much more than the commodities that underlie it. So that's my first question. And the second one is, I can see the attraction of your company as opposed to a small mining company, because the risk is a lot less. You're much more diversified, both in types of commodities and number of assets. But what is the attraction compared to, say, a BHP or a Rio Tinto, who by definition are diversified? I mean, they're obviously multi-billion companies invested in many different commodities.
If you can, Mark, big questions, but we're trying to get a couple more questions in and running out of time. So quite quick answers if you can.
Yeah, I think the short version is top-down primarily. Bottom-up, our business has performed well year to date. I mean, year on year, we anticipate higher volumes this year versus last year. Commodity prices have been higher. You'd expect higher portfolio contribution year on year versus 23, but our share price has traded down. I think part of that is sort of risk-off and bigger top-down macro concerns that's impacting our business. Bottom-up, from an asset-level perspective, not much has changed, certainly not in terms of materially impairing any of the assets of our business. The second part of your question, it depends what you're looking for, right? I think if you're looking for a lot of exposure to iron ore with both those names, and if you're looking for sort of returns to equity, then I would, by all means, a mining company may be for that investor. If one is looking for top-line commodity price exposure, then I would advocate a royalty company. So in other words, if you're looking for a higher beta stock than the mining company, if you're looking for a lower beta stock than the royalty company.
Okay, question here. Thank you.
I'm assuming you raise money through the markets, and you've been doing so over the last 5 years. If that's the case, how do you raise money through the markets, and how much have you raised as a company over the last 5 years?
Yeah, our business model definitely relies on capital. Increasingly, as we've grown our portfolio, we bootstrapped our financing capacity from a $10 million revolving credit facility in 2014 or 15 to now $225 million, inclusive of an accordion for growth. And so, as our assets produce more and as we buy more producing assets, we're able to self-fund much more. In the past, we have raised equity as and when on a transaction-specific basis, usually by virtue of an accelerated book build, or I think in the UK it's called like a cash box, technically speaking. A cash box placing, or like a 20%. Yeah.
And one final question here, please, Chris. Thank you.
You've shown us the revenue forecast for 24 and 25 on the slide for 25 is less than 24, with Kestrel going down again in 25 to 24. I wonder if you could share with us your current forecast on 26 best guess forecast when Kestrel finishes, and indeed 27 if you have one.
Yeah, so Kestrel by the end of 26 will materially run its course, assuming the current rate of production. So, if you're looking at Ecora, I think that's a really important thing to understand, is that after 26, Kestrel will likely not be contributing meaningfully to the revenue profile. The expectations currently, although this can change depending on the pace of mining, are that 2025 should see, certainly less than 26 should see less than 25. The question is how much less. I think we're going to see that over the course of this year. The thing to focus on, I think, when you think about the Kestrel runoff, is sort of this number, which is our producing portfolio, and that's kind of an average for 24, 25. So, an average for 26, 27, 28, 29, 30. So that number itself will certainly be volatile depending on commodity prices, and it'll be volatile based on underlying production. But that is, the meat and potatoes, so to speak, of the portfolio. And everything above that represents, growth that's not yet in production that could come through, although is certainly not, certain.
Mark, thank you very much indeed. Are you going to be around for a drink afterwards?
Yeah.
Are you going to go? Well, come and grab Mark later if you have further questions. Thank you very much indeed.